Welcome, friends. In the previous two sections, we have seen individual security and portfolio of securities. In both of the cases, we have seen the expected return calculation when different probabilities are given, how to calculate the expected return, how to calculate the variance, standard deviation, covariance, and correlation. Of course, the last part of our discussion will be all these calculations to calculate through the Excel spreadsheet. Of course, we will take the actual stock, the market proxy from S&P, and we will do the calculation. We will take one of the mutual fund and calculate. So first, let us calculate. Let us understand the theoretical representation. The question here is the expected return before the announcement comes, the analysts make an expectation. Okay, this time, this quarter, this company will have an expected return of 12%. But when the announcement comes, it may be more than 12%, it may be equal to 12%, it may be less than 12%, isn't it? The analysts, they expect something, but the actual announcement might be more than that, might be less than that. So, why such kind of surprises happen? When the announcement comes, it should be as per the expectation because the analysts, they use different kind of mathematical models, like we use the dividend discount model, we use the free cash flow to equity, free cash flow to farm, and we make all the kind of probabilistic estimations. Then we calculate the expected return. The announcement should give the same return, but in practice it may be more than that or less than that. Where the surprise comes and how it happens, let us understand. Return on any security consists of two parts. Remember, first one is the expected return, what the analysts expect. The other part is the unexpected return or the risky part. The risky part may be, or unexpected return may be positive or negative. For example, the analysts may make an expectation of 12%. Now, if there is an unexpected positivity, then there will be, for example, 3% unexpected positive return. Then what happens? Expected return 12% plus 3%, the actual return will be 15%. Other way around, the expected return was 12%, the unexpected was negative 3%. Then the actual return will be 12% expected minus 3% the unexpected loss is equal to 9% the actual return. So, the formula we can write like this: the actual return is equal to the expected part of the return plus the unexpected part of the return. As I explained you, the expected part of the return, for example, 12%, plus the unexpected part can be positive or negative. So 12, if the unexpected part is positive, 3, then 12 plus 3 will be the 15% with the actual announcement. If the unexpected part is negative, then 12 minus 3 is equal to 9% will be the announcement or the actual return. Therefore, every time the actual return is equal to the expected return plus the unexpected return. So both taking together will be the actual return. So the expected part, all analysts, they make the expectation, they make the forecasting. So expected part announcement is always a sum total of the expected part plus the surprise part. The surprise part will be, for example, there is a good news. The company will go for a merger and with another company. Because of that, the company's profit margin will go 2% higher. Merger, takeover, the new government order or new order taken, new market explode, all these are the positive surprises. Negative surprise also will reduce the announcement. So expected part plus the surprise will be always equal to the announcement or the actual return. The expected part of any announcement is the part of the information the market already expected or anticipated or forecasted. The surprise is the news that influences the unanticipated return on the stock. That is the U. Because the every company, this is true. This model is applicable for every stock, for every company. Therefore, what is required? The requirement is we have to go for a diversification. Why we need to go for a diversification? Reason is every company has its provision of unexpected return. It may be negative, it may be positive. So if you have a diversification, one's loss will be adjusted with others' profit, or others' profit will others' profit will adjust the stock A's profit will be adjusting stock B's loss, or stock B's loss will be set off with stock X's extra profit. Therefore, you should have always a diversification between two or three stocks instead of one. So you should have always a balanced portfolio in which the risk will be reduced and the return will be increased, as we have seen the bond fund and stock fund from 100% to 0%. Diversification can substantially reduce the variability of returns without an equivalent reduction in the expected returns. We have seen for the bond and stock fund, we started with 100% bond, 0% stock, and we reached with 90%, 80%, we reached with 0% bond, 100% stock. So in both the cases, extremes, it is non-diversified. And we have seen with 35% stock and 65% bond, we have the highest return and lowest risk. This reduction in risk arises because worse than expected return from one asset offset by better than expected return from the another asset. As we have seen, always the return is equal to, the announcement is equal to expected plus the surprise. So one stock will give surprise positive, the other stock will give surprise negative. It might happen. Therefore, if you have a proper diversification, the reduction because of the worse from one asset will be offset by better return from the another asset. Therefore, diversification always gives a balanced return. However, there is a minimum level of risk always present in the portfolio that you cannot minimize, that you cannot reduce. That part of the risk which cannot be minimized or reduced is known as systematic portion of the risk or systematic risk, which cannot be minimized, which cannot be reduced. But the unsystematic risk or farm specific risk, it can be diversified, it can be reduced, it can be minimized. Let us see how. In a large portfolio, normally if you have 50 stocks, for example, you have a large portfolio of assets. Then what happens? The diversifiable risk or non-systematic risk or farm-specific risk, unique risk, all these are the names used for non-systematic risk. Diversifiable, non-systematic, farm-specific, unique risk. This can be minimized. The x-axis talks about N, number of securities in the portfolio. Y-axis talks about the standard deviation or the risk. You can see when the N increases in the x-axis, the risk reduces. The standard deviation reduces in the y-axis. And it reduces up to a level. After that, if you go on increasing the asset also, it is not reducing the risk. Up to a level, the risk is reduced. After that, it becomes flattened. The risk is not reducing. The standard deviation remains the same. That means, after that particular level, there is no farm-specific risk present in the portfolio. There is no diversifiable risk present in the portfolio. That is completely reduced, minimized. What remains? The systematic risk remains. The market risk remains. Non-diversifiable risk remains, which cannot be reduced. So the curve became flatter. After a level, if you go on increasing the asset also, your risk is not reducing. Why? The risk which is present there is the systematic risk. With proper diversification, you have reduced your non-systematic risk or farm-specific risk or unique risk. You have reduced. You made it zero. Which is present? The systematic risk is present. So, a systematic risk is any risk that affects a large number of assets, each to a greater or lesser degree. So, the risk which will be there for the whole industry, for whole economy, is the systematic risk. What is unsystematic risk? It is only for a specific company or a group of company, or a group specific asset or specific small group of asset. Then it is an unsystematic risk, which can be minimized, which can be reduced, which can be diversified. But the systematic risk, because it is whole economy or whole industry is suffering, so it is diversified. This one is very difficult or not possible. Unsystematic risk can be diversified away. As we have seen in the previous graph, it can be minimized up to zero. But the systematic risk, it remains. After that, if you go on increasing asset also, your risk will not go down. Why? Because that is the systematic risk. That is applicable to each and every asset in the industry. Therefore, diversification is not easy. Examples of systematic risk is about the economic condition. Now, for example, the COVID-19 situation created to the whole economy. The gross national product is affected. Gross domestic product is affected. The inflation is going up. Interest rates are going up. These are not applicable to any particular company or any particular stock. But strike, lockout, all these are unsystematic risk. They are increase in material cost, increase in the total cost. These are all specific to a company or specific to a group of companies, a specific asset, group of asset. Those are unsystematic risk, which can be completely diversified if you have a proper diversified portfolio. So the total risk is equal to systematic risk plus unsystematic risk. And if you are properly diversifying, your unsystematic risk will be zero. We have seen in the graph here. With proper diversification, your unsystematic risk or diversifiable risk or farm specific risk is zero. Therefore, if the total risk is equal to systematic plus unsystematic, in a proper diversified portfolio, unsystematic is zero. Therefore, in a proper diversified portfolio, the total risk is equal to only the systematic risk. And in that situation, we have introduced here risk-free rate of return. And you have seen for the stock fund and bond fund, 100% bond fund, 100% stock fund, highest return, lowest risk. We have drawn a we have drawn a market frontier. We have drawn, and once your efficient frontier is drawn, taking the highest risk, and lowest standard deviation, we have drawn the frontier. After that, we have introduced the risk-free rate of return with the T-bills. So that much of return is totally risk-free. And we have different sets of bond fund and stock fund, different sets of portfolios are given here. Their return and risk portfolio is drawn here in the graph, and an efficient frontier is drawn. Now what we will do, we will market the capital market line we will draw here. How we will draw here? The capital market line will be the stiffest line from the risk-free rate of return. So the complete stiffest line will be drawn as the security market line or capital market line is drawn here. You see, this is the stiffest line available we have drawn. Then we got the steepest slope we have drawn here to calculate the capital market line, and that we have pointed as M. Now we have different sets of uh, portfolios. Somewhere it is 100% stock fund, somewhere it is 100% bond fund, somewhere it is 95% bond, 5% stock, somewhere it is 5% bond, 95% stock, somewhere it is 90% stock, 10% bond, somewhere it is 10% bond, 90% stock. Different portfolios are presented here. And the with capital allocation line identified here as the CML, all investors choose a point along the line, some combination of risk-free asset and the market portfolio M. To what extent risk-free asset and market portfolio depends on the risk appetite. In a world with homogeneous expectations, everyone's expectation remains the same, they are homogeneous in nature. M is same for all investors, isn't it? So it depends on how much appetite the investor is, or risk tolerance, we can say risk appetite or risk tolerance. Based on the risk appetite or risk tolerance, you will take the particular portfolio. If you are a very high risk taker, your risk tolerance is very high, you will go with 100% stock. That is also in the CML, in the frontier it is coming, 100% stock. You will get high return, at the same time you take high risk, because you are high risk taker, your tolerance is very high. Another guy whose risk tolerance is very low, what he will do? His risk tolerance is totally zero. He doesn't want to take any risk. Then he will take 100% bond. His return will be low, even less than the risk-free rate, and his risk also low. Another investor who is a balanced one, he will take maybe 35% stock, 65% bond, with a balanced kind of risk return tolerance. So, but all these three guys are in the efficient frontier, you can see here. So any combination if the homogeneous expectations are there, the risk tolerance or the M remains the same. Right? So this is the way researchers have shown that the best measure of the risk of a security in a large portfolio is the beta of the security. So if you are having large portfolio having many securities, then it is a large portfolio. In a large portfolio, beta might be the best measure of measuring the risk. Beta measures the responsiveness of the security to the movement in the market portfolio. And normally, if it is a larger portfolio, we have seen in the previous graph, if it is a larger portfolio, then N is the number of stocks. If N is larger, then your unsystematic risk normally minimized. Then what remains is the systematic risk. And the best measurement of systematic risk is beta. How we calculate the beta? Covariance of the stock with the market divided by the standard deviation of the market square. We can calculate this in the regression line. In the spreadsheet, we can calculate the regression line. I will show you how to calculate the beta through the regression line in the spreadsheet in the last part. So, if you don't want to calculate the regression, you can directly use the inbuilt function of the spreadsheet called slope, which we have calculated in the last chapter. We calculate the slope for Amazon in the last chapter. Again, we will calculate the slope here today, and we will also calculate the regression line in the spreadsheet, which both are in seconds you can do. So formula for beta is, as you have seen, covariance of the stock with the market divided by standard deviation of market square. Or else we can use the correlation multiplied by the stock standard deviation divided by market standard deviation. Either of the formula we can use to calculate the beta. But we can calculate that through the spreadsheet in seconds. Let me stop the recording here.